Well, I'm going to start out. I've been in crypto for a long time, so I started out when there was no such thing as raising money. It was primarily a collection of like software developers, engineers in forums discussing how they could solve very unique problems. But a lot of those problems turned out to be very transferable when we think about the issues related to smart contracts. So I guess when I'm thinking about a security token, I always come from the coding or the engineering side and say, it's not necessarily a security in terms of a financial asset. It's the right to have some code executed. So when you think about it in those terms, the actual definition expands quite drastically, where if we're going to regulate or think about the STOs as a security, we have to think about it the right to execute some code function. So it doesn't necessarily mean that there's an asset underlying that you have any right to. It means you have a purely digital execution call that you have the right to execute. So I think there's that side of the equation, but I'm sure the other guys can bring a more of a kind of a financial take on it, but I always think of it as the right to execute something in a distributed application. So
maybe I'll add on to that. So I think for utility tokens, this was a very new concept that came about as a result of the ICO model. And for startups, it was really awesome because it was like, oh, hey, look, I can raise money, but at the same time, I give up no equity as well. And what we've actually seen in this bear market is that you're actually in a situation where you actually see some startups, they actually have more money in the bank than their market cap of their tokens. And so what this means is that if you, as a utility token holder, you think that, oh, but that's not right because well, the book value is actually higher than the market cap, which means like you should be buying those things. But the actual fact is that as a utility token holder, you actually have no rights over the startup. So I think what we're kind of seeing is that for utility tokens, I think there are some blockchains out there with real utility, say case in point Ethereum, where you actually can do something with the ether, but the majority of projects out there, it's kind of hard to kind of define what sort of utility you're actually getting out of it. And I think it's kind of the market starting to realize that, hey, like actually when I invest in something, I don't just want to invest in something that's kind of like a little harder to define, like utility, but equity is something that I think people actually understand as a very well-defined concept. And also, with it's not just about startups raising money, but potentially the exciting thing about security tokens is that you can have actually real assets that actually back these things. So, it could be, let's say you're trying to tokenize a factory, or, you actually have like accounts receivable that you actually want to tokenize. So there are going to be actual things, with cash flows that you can actually model. And these will actually give value to the token. So, I would say, yes, it's a bit of sort of the market is also maturing. The market is also sort of waking up to, the fact that, perhaps not a lot of these things actually have utility, but, having like assets actually backing it or, giving up equity, that's a concept that people are a lot more comfortable with. And I think you start to see like, emergence of different sorts of companies, not just startups, but also like asset owners and traditional companies try and look at this model of trying to raise capital via the security token model.
I mean, Thomas, from a regulatory point of view, how should STOs be viewed?
Yeah, thanks. when I think it was back in 2013-14 when I first got a look at the Bitcoin side of what we're looking at, and Ether was still a vision, and it was just coming to the forefront. So, I mean, Ether is the backside of what we know as ICOs today and STOs. I mean, so my vision always was that they weren't separate. It was just a means to an end. So the ICO was like the pre-IPO. It was the money, it was the seed capital, but it was the means to an end was always going to be when I first started to write down my ideas, and there's a couple of people in the room that I shared this with years back. I always believed that there would be asset-backed tokens. I didn't call them STOs. That acronym has come recently. But I always believed that there would be a fundamental underlying asset, whether it was a security or a bond or an interest rate or a dividend or a fractional ownership in real estate. And actually real estate was one of the things I first wrote down. But I come out of the commodities world where there's a lot of fraud. And if you look at the exchanges today, other than an equities exchange, the issuance of defining documentation for ownership is still a very murky and blurry world, proprietary. Each exchange does it differently. There's no unified standards. There's been some standardization around equities because of like the DTCC and the US and things. But still, you're from Hong Kong. Hong Kong does it differently than Singapore for the DTP and things. So there's still a lot of question marks around ownership. I always saw the standardization model around what we now are calling STOs as just that. It standardized the process. The chain unified the processes. The smart contracts on the back end of it would standardize the use cases, and that it would become a very fair playing field. The regulators then went, it's way too disruptive, and that's where it gets to the regulatory standpoint. There are no standards of recording of ownership outside of regulated brokerages. So if you're in Hong Kong with the SFC, or if you're with MAS, you're up against SGX or the SEC or the CFTC or the FCA, METI, MAF, MAF. I mean, there's a gazillion of them. Everyone looks sort of the same, but if you look at their tax and their ownership and rights and everything, are all very different. So the regulators looked at this thing that actually looks too simple, believe it or not. When you talk to them and you go, this is probably the cleanest record-keeping model you'll ever get in your life. It actually satisfies an immense amount of the post-Lehman demand for data collection, aggregation, and definition, even on a daily basis, real-time auditing. I mean, it's amazing how efficient, right? These are things, but everybody's like, wait a minute, you're going to disrupt the brokerage industry, the banking industry, and me as a regulator, maybe I won't have a job tomorrow because it's going to become way too efficient. It's fear factor more than reality. And I think we're at a point, sort of that progressive chart that they had up before, a year on from where we were in 17 with all the noise around Ether and ICOs, to a year on where you've got major entities adopting even digital national currencies are now being test beds. I mean, you guys were part of that, the Project Ubin. You're looking at M1 in major central banks that have already test bed, and IMF, World Bank is one of them. FedCoin was just announced by Goldman Sachs 2 days ago. Trust me, Goldman Sachs could not have announced that if they hadn't gotten the U.S. Treasury to say, yeah, you can do an M1 FedCoin. That's the reality where we're going forward. So the fear of adoption is greater than the actual adoption. It's like anything else. Change is the scariest thing. Once you change and adopt, people realize the value of going forward. And I think we're really at that push of transition. We've gotten the buzz of the $20,000 Bitcoin or the $1,000 ERC20 token is gone. So it's not the bloom off the rose. It's a reset to an actually valid systemic shift. And we're seeing that systemic shift adopted by mainstream industries, whether it's just for ID, like in Zug in Switzerland. They've now, the entire canton of Zug have adopted digital health, IDs, digital passports, and basically individuals can carry all their ID and at the government level and pass through borders. So now the rest of Switzerland is going, hey, that's a really good idea, maybe we should do it nationally. You've got projects here that are being explored by MAS that they will be adopted in time at a government level as much as individual business levels. So it's a slow transition region by region.
Okay, let me ask the audience this. Who would buy an ICO today? Who would buy an STO today? Why? And I think the why is possibly, let me guess, the asset. Access to the asset, direct linkage to the access, right? Yep. Now, we heard from Alice her opinion on what an asset actually is. It was a very interesting example. I would have actually called it an asset. She doesn't think it's an asset. Who is going to call what an asset? Who is the body? Is it the community? Or is it the industry? Or is it a regulatory body that says, this is an asset, this is not an asset? Who's going to say that?
I just want to ask a question. Who here owns shares, equities? Right? Do you have any idea where they are? Yeah, exactly. Yeah. So, it's somewhere, and you've got a trust factor on where it is. Okay. Anybody opened a bank account recently at DBS? I'm sure a few people have. Or you've been pinged on the new digital banking system at DBS or Paylon, right? Do you have any idea where your money is? You've got implicit trust that it's somewhere. It's sitting in a digital platform, but it's in a proprietary platform. It's not in a standardized platform. And the point is, those are both disruptible. Banking is disruptible and equities are disruptible. But we understand those assets. We understand our own money. And we understand a share of stock, say Temple Steel or IBM. Who here owns a property? Pretty much everybody, right? Or you got a lease on a property, right? Okay, so that's got an income stream to the defined owner. The guys who own the property, do you have an idea where your property documents are? Maybe, right? You probably got a box in your house. A safe deposit box? Maybe not. Right? You can define that in digital structures. Again, a disruptible industry. It's geometric what can be changed in what we're doing here. Those are all assets. We understand cash as an asset. We understand share of stock, even though it's electronic. And it's been electronic for a long time. First electronic shares were created in 1989 on the Tokyo Stock Exchange. And no one has ever questioned that the share is electronic. But we're sitting here going, wow, electronic digital asset? We're already in that age. We're changing the metric and the acceptance. We've already accepted it, right? You have PayWave, right? I'm sure anybody who lives in Singapore has already gotten into a case where you actually don't carry cash. Even though people are fearful of being cashless, we're already cashless. It's really a lazy man's way of spending your own money. Right? It's not debit. Well, it is debit because it's your own money. It's not credit, I should say. But we accept credit. Right? A credit card's been in the system since 1949. Citibank and Diners Club. We didn't think anything of spending money that actually wasn't ours. Right? It was electronic money. We've already adopted the practices of a system that we're moving forward to, we're discussing tonight.